Welcome to the Bankless by Design podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Tricia Miller, mom of 7, financial coach, and founder of ThriveWell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place.
Hello, and welcome back to the Bankless by Design podcast. All right. So over the last couple of weeks, I have been answering the critics from the buy term and invest the difference crowd regarding whole life insurance and the infinite banking concept. And in large part, I have focused on the biblical and virtuous origins of whole life insurance and IBC versus speculating and the risks associated with buying term and investing the difference in mutual funds. And yet I get people saying to me, look, if you really want to stand up to the Dave Ramsey followers and the like, you need to show them some evidence. The numbers don't add up, so prove him wrong. In other words, show me the numbers. Well, let me just say from the outset, this very question presupposes that whole life insurance and the infinite banking concept should be compared to an investment. That is problematic when our presuppositions are incorrect in the first place. It's starting from a faulty premise. So let's go back to the introduction of becoming your own banker for just a minute. On page 3, at the top right column, it says, this book, or the infinite banking concept, is not about investments of any kind. It is about how one finances the things of life, which can certainly include investments. It's not about rates of return. And I'm going to add, nor should it be compared to an investment. As time goes by, though, interest rates are up and interest rates are down. But the process of banking goes on no matter what is happening. So when someone comes to me and says, show me the numbers, prove them wrong with the numbers, well, that's asking me to stack up some kind of numerical comparison between the infinite banking concept and this idea of buy term and invest the difference. Well, frankly, that is comparing infinite banking and whole life to an investment, and it's not. It shouldn't be compared to one. And of course, this is also very nebulous because you have to ask yourself, well, when you're doing buy term and invest the difference, well, where are you investing it? What mutual fund? What's the market timing? During a bull run? During a bear market? How long has it been held? How much term are you buying? For how long? What if this person dies young? What if they don't and they never see their dollars back? There are so many variables here, not to mention that you are still presupposing that whole life and IBC are an investment, and it simply is not. All right. So Nelson Nash, the discoverer of this concept, says that the infinite banking concept is an exercise in imagination, prophecy, logic, and reasoning. So I'm going to attempt to help us use our imagination, our logic, reasoning, and prophecy instead. When you become your own banker, you are using a whole life insurance policy to operate or to conduct the process of banking in your life. And it has all the components of a banking system. It allows you to have all of the staff and administration already in place so that you can be the depositor. You act like the depositor when you pay a premium. You can also be the borrower because you can collateralize your available cash values. And then you also, here's the other new hats you get to put on that you're not accustomed to. You get to be the banker because that means you get to set the terms of the loans and the payback schedule. How much you're going to pay back, when you're going to pay it back, if you're going to pay it back, at what interest rate you want to set for yourself. You name it. Okay. So then you become the banker. You are also becoming the bank owner because you actually get to participate in the profitability of the insurance company when they pay a dividend. So in other words, you get to have complete control and access to capital so that you can finance all of your needs in life without third-party banks. And of course, key to understanding this concept, don't forget, is that you finance everything you buy, whether you are borrowing to do so or whether you're paying cash. There are absolutely no exceptions. You either are paying interest to a third-party bank or you're losing the interest that your money could have earned otherwise had it not been spent by paying cash. Okay. And if you don't grasp that concept, it's very hard to make sense of the infinite banking concept, because otherwise you're wondering, why in the world would you ever borrow against your own policy to access your cash values? It's because you're already financing anyways, and you just don't always realize it because we don't take into account the opportunity cost. Okay. But what this means when someone wants me to show them the numbers, well, the reality is I can't really show you the numbers. Instead, I would have to say, you might have to show me the numbers, or you might have to show yourself the numbers to prove it to yourself. Okay. So here's a little exercise how you might consider doing this. So perhaps if you collected all of your past mortgage statements from every home that you've ever purchased since you started working as an adult. Okay. Then gather all of your car loan statements from every car or truck that you've ever owned. Heck, throw in the boats and the motorcycles too. Your student loan statements, maybe your wife's wedding ring. I don't know, your credit cards over the years, all the lines of credit you've ever had, furniture loans, all of them. Gather every single loan you can imagine that you've ever had in your lifetime, in your personal financial world since you started working. Now add up the total amount of interest, not the percentage rate. We want to look at the total volume of interest that you have spent on all of those combined purchases over the course of your lifetime. How much money do you think that would be? Are we exercising our imagination yet? Okay, do that and write that number down. Take a whopping guess. I don't care. But let's walk through this exercise. Okay. But now I want you to take one step further, because this also applies to your cash purchases as well. So you can go add up all the cash you've ever spent over the course of your lifetime. Now, maybe an easier way to do this would be to just consider all the income that you've earned over the course of your lifetime, subtract the amount of interest that you've paid that you just came up with, and keep that as a separate number. Okay. And subtract any of the money you've actually kept. And then that dollar amount, take that as like all of your cash purchases and multiply it by, I don't know, you can choose a modest 3 or 4% interest that perhaps you could have earned if you hadn't spent that money. And now don't forget to multiply that over the number of years that you have earned an income. I know this is not an easy task, but using a little imagination, logic, and reasoning, you can give yourself the best ballpark estimate that you can. Okay. Now add this total dollar number from the cash purchases and the interest to third-party banks over your working life. Okay. And now you tell me the numbers that you may have been able to still own and control had you been participating in the infinite banking concept this whole time. And maybe you want to compare that to the earnings that you've made with your method of buying term and investing the difference. Okay. But we're not done yet, because this is not including 2 more items that could be added to this mix. Again, using our imagination a little bit. If you even had half of the number that you just came up with available in cash, what opportunities do you think you could have been able to capitalize on at a much greater rate than 4% had you actually had access to capital? So think about this. How many people have $300,000 to $500,000 sitting in their qualified plans invested in mutual funds that if they knew how, or they had the cash available, could have actually purchased, I don't know, 10 or 20 rental properties, now all cash flowing every single month and appreciating in value over time? Or maybe you don't like the trouble of rental properties, but what if you could have even just been a private lender, lending to real estate investors at 10 or 12% plus points over the years? Well, if real estate is not your investor DNA, let's shift gears a little bit. What business could you have started? How much could that business have generated for you? I don't know. Maybe you're a business owner now. How much more could you have expanded your business had you been properly capitalized? Do you see why this is not so much about the numbers as it is about imagination, prophecy, logic, and reasoning? Okay. Let's switch gears here for just a minute, because there's another way to think about this. Maybe your child came down with a debilitating disease and insurance wouldn't cover the treatment that they needed. But now you had access to capital and you could provide for that need on your own. How much value would you assign to that? Or your kids are government employees and they just went through a shutdown and they needed to pay their rent or their mortgage, but they couldn't. But you had access to capital, so you could lend them a hand in a tight spot. What value do you assign to that? You see, you cannot put a number on how valuable it is to have access to capital on demand. Frankly, there is no comparison here whatsoever between buying term and investing the difference, which is 99% of the time referring to locking your money up in a qualified plan that you cannot touch without penalty or loss of growth or a tax bill. Access to capital and control is the magic sauce of the infinite banking concept. I think so much of the time people close their minds to the infinite banking concept because honestly, they can't imagine what they could do better than their mutual funds. They don't know how to invest in anything on their own. Maybe they haven't taken the time to learn and thus they're fearful. I don't know. But before I digress too far, let's go on because there's more. There's also this thing called the velocity of money. How many times are the dollars in your mutual fund being used over and over in your life? The answer is once. Your dollars can only do one job in a mutual fund. They can only buy shares in the fund. But this is not true with the infinite banking concept in whole life. I can use $1 to purchase a death benefit that will go to my heirs tax-free. It will also grow without risk perpetually into the future and create more cash value. It can never go backwards. That is powerful. Then I can collateralize that same dollar and use it over and over and over to finance my needs, to purchase even other investments. So now I could have a dollar that's growing sitting inside my policy, which has purchased a death benefit to go to my heirs tax-free one day, and I can collateralize it, and I can go put it in another investment and grow it over here as well. I can effectively use those dollars multiple times. How do you put a dollar value on that? You can't. You have to use your imagination, logic, reasoning, and prophecy. It's really a fool's errand to try to compare the two. They don't even come close because of so many factors. All right. I haven't even touched on the growth inside the policy. All people want to do is look down the lines on the illustration and see those numbers and think, that is what I need to look at. That is the number that needs to be compared to an investment. But what I'm telling you is you cannot. Any of the things that I've already talked about are not even seen on an illustration. The growth in your business, the purchase of rental properties, the caring for your sick kid, none of those things show up on the illustration. The fact that you're using those dollars more than one time, it doesn't show up on the illustration. But I get told, show me the numbers. Okay. So I'm going to do my best to show you a little bit, give you a sneak peek into the numbers on the illustration. But what I'm trying to emphasize here is that these are the least significant numbers. The least significant part of this whole concept is the numbers on the page. And I'm going to give you a couple caveats too. To be fair, everyone's numbers are going to look different based on your age, your health rating, and your gender. So even any numbers I can possibly give you are going to be different for your numbers. And what you as the policy owner does with the policy also has far more bearing on what the policy does than anything else. The life insurance company is going to do what the life insurance company is going to do. But depending on what you do, what investments you might make, how much you actually use it for infinite banking to take over the banking function in your life, and whether or not you're an honest banker and pay yourself back with interest, all of this has a bearing on the policy that is far greater than anything else. All right. But with all those caveats, to maybe satisfy this itch just a little bit, I'll give you a simple example. So if you want the numbers, I suggest you get out a pen and paper because I'm not showing illustrations that you probably don't know how to read anyway. And I don't have the tech savvy to put the numbers on the screen. So you're going to have to write them down. Sorry about that. All right. Let me just start with a sample 40-year-old female. We're going to name her Sally. Now, this isn't someone super young, but she's certainly not old either. I'm going to give her a standard health rating. So she's in good health, but she's not super preferred either. Just trying to give you some middle of the road stats here. She's going to pay a $10,000 premium per year just to give you nice, round, easy numbers. That's not a very big premium, but let's just say if she's making $100,000 per year, that's 10% of her income. That's what we should all be saving at a minimum. Now, if she's making $50K, that would be pretty good, right? That'd be 20% of her income, which would be even better. But we'll just say this. Okay. But something else about this $10,000 that you have to understand, because this is important. Of that $10,000, only $4,000 is the minimum annual premium that is required to keep the policy alive. The additional $6,000 premium, because of the way I've designed this policy, goes towards the paid up additions rider. And while it is optional, I do recommend paying it to the max because that is going to supercharge the growth in this policy. But there is flexibility here. And this is part of what is wonderful about these is that if you have a bad year and you can only pay the $4,000, then you can do that and still keep the policy alive. We don't want to do that. We want to maximize it, but flexibility is there. But Sally, she's going to pay her $10,000 every single year for 30 years in a row because her policy is designed to accept that much premium. And Sally is a good and honest banker. She knows the power of dividend-paying whole life insurance, so she pays every bit of her premium to the maximum in this example. Now, starting in year 31, she can only pay $3,000 for the remainder of her life until she is 95 years of age. And I say only because when she's 80 years old, she will wish that she could pay more given what's going to happen with those dollars when the premium is paid down the road. You see, with the infinite banking concept, we want to pay as much premium for as long as possible because we know that we're going to need a place to warehouse that wealth. Otherwise, it's going to land on the books of somebody else's bank, and we want that to land on the books of our own bank where we can have uninterrupted compounding interest as long as possible in a system that we own and control. So if somebody gave you a policy and told you that you should only pay for 4 or 7 years and then start a new one, I'm telling you, they did you a disservice. Okay. So Sally, for 30 years, she gets to pay $10,000 a year. And the last 25 years of her life, she gets to pay $3,000 a year for a cumulative premium over her lifetime of $375,000 if she lives to age 95. So what does she get in exchange for this premium? I'm going to walk this out with you. Let's start in the beginning. On day one, she pays her $10,000 premium and she immediately has a $196,000 death benefit should she be killed in a car accident the very next day. Okay. The life insurance company will be on the hook to pay that out to her beneficiaries tax-free with no probate. That's not a bad deal. And every year that death benefit is going to grow larger and larger. But what else? Well, within 10 days of starting that policy, going into force, she will actually have access to approximately $5,800 of the $10,000 that she paid available in cash value that if she needed it, she could collateralize that. So the actual loss of liquidity of her $10,000 premium in year one is about $4,200. And of course, remember, it did pay for that death benefit and all of the expenses associated with that at the life insurance company. But that is the worst it will ever be. Year two, she pays another $10,000. Within 10 days of that payment, she has access to approximately $12,000 again within 10 days of paying that premium. But now she has a $214,000 death benefit. And by the end of year two, she actually has access to almost $14,000 because it's growing over the year and gaining a dividend. By year 4, she's cash flowing, meaning that when she pays a $10,000 premium into her policy, that $10K is increasing her actual cash value available that year alone to $10,292 just on that one $10,000 payment. So from here on forward, there is no loss of liquidity of her dollars at all. And she now has an ever increasing pool of capital that she can access on demand. So let's actually calculate the startup cost on this policy. The total loss of liquidity in the first 3 years to get this thing started is $5,121. Now, keep in mind, we are actually starting up our own banking business. Do you think that is too much to start up a business that is going to now profit you for the rest of your life? I'm always blown away at the fact that people will put their money into a fund that they cannot touch without penalties or taxes or see any benefit for 40 years. But they will cry and scream that starting up a policy has a little bit of loss of liquidity in the beginning. You see, it's all about the way that you think. It's what Nelson always said. All right, think about it. What business owner do you know that doesn't expect to have some startup costs? I can hardly buy a rental property and have as little cost to me as $5,121 to get started. I mean, that would be a drop in the bucket for buying a rental property, and I expect to have to capitalize on that. I have to put that down payment. All right. Heck, I have to spend a lot more of that on starting up my life insurance business. I have marketing expenses, license expenses, conferences, computers, printers, equipment. You get the idea. To start a business, there is going to be some expense. All right, but let's move on and see what it's going to do for Sally long term. 10 years in, she's now paid $100,000 worth of premium, and she has access to $110,000 worth of cash value. and a death benefit now of $370,000. So again, some would complain that's not a lot of surplus, but don't forget, she can be saving it here and spending it at the same time while having an increasing death benefit, using it to take over the financing in her life. So think about what bank loans could she take over at this point with $110,000 and now be paying herself back with interest instead of sending that interest to the bank. All right, but let's move a little further down the road. Nelson taught us to always think long term. This is a long-term program. So 20 years down the road, she's still paying $10,000 in premium each year. But in 20 years, when she pays that $10,000 premium, that premium increases over the course of the year, that alone, to a $22,686 worth of increase in her cash values. So now her $10,000 is more than doubling, and her death benefit has increased to $614,000. By year 30, when she's 70, she pays her last $10,000 premium that year. And with the interest and dividends, her $10,000 goes in, and by the end of the year, it has increased her cash value to $35,404. She's now more than tripling her $10,000. And her death benefit has climbed to $928,000 should something happen to her. Let's go out to age 80. Now she's only paying $3,000 worth of premium that year because she can't put any more money into the policy. And it's increasing its cash value that year alone. When she pays a $3,000 premium, her cash value that year increases by $43,706. It has multiplied that year by 14 and a half times. Now, don't you think at age 80, she might be wishing that she could actually pay $30,000? Because if she could 10x her premium, she would 10x that cash value. Okay, she would have put in $30,000 and it could have increased her cash value to $430,000 that year. So you can see why more premium is better up front, because down the road, you're not going to be able to pay as much. So the more you pay in the front, the more this is going to happen in the end. Okay. But even if she just doubled that $3,000 to $6,000 instead of $43,000 worth of cash value, her $6,000 would have turned into $87,000. You get the idea. This is an exponential curve. And some people might say, what if the 80-year-old woman can't come up with $3,000 per year at that point in her life? Well, did I mention that was just the increase in that year alone? At this point, she now has $955,000 worth of cash value available. I think she could borrow against that and take out $3,000 to pay her premium. It'll be small potatoes. All right. This is where it's a cash flowing asset, and it cash flows better the older you get, which is exactly when you need it the most. Don't we all really just want guaranteed income for life at this stage? I mean, if you're in buy term and invest the difference and you're taking out this kind of money, you're drawing down the amount of money that's invested. And if you have any turn in the market besides that, you're losing principal. And the older you get, the more you're concerned about, will I outlive it? In this case, no, it's getting better every single year. It's a peaceful, stress-free way of life because it's going to only increase. And that's not an if, that's a guarantee, because the cash values must rise to meet the death benefit at age 121. Okay. Now, yes, these numbers assume that the company is paying a dividend, and dividends are not guaranteed. Legally, they are not guaranteed. But remember, I only work with companies who have been paying a dividend every single year consecutively without fail for more than 100 years. And even if it doesn't pay that dividend, it can't go down. It's still going to grow. But further, once that dividend is declared in the year that it's declared, they can't take it back. It can't go backwards, unlike the losses in your mutual fund, where a gain can then be lost. It's only really a gain on paper until you sell. In fact, you don't know how much you actually have in that fund until you call them and say, I want to take out some money. And they'll tell you, well, we'll let you know what that is once the bell rings at 5 o'clock, because they don't know until that bell rings on Wall Street. All right. Let's keep going. Let's also remember that cash flow that's being spit off that policy of $43,000 on $3,000 worth of premium. That's not even dipping into the cash value available of $955,000 at that point. that you could do if you needed more income. But more importantly, let's think about this. That $43,000 of increasing cash value can be accessed tax-free. That means if you want to compare that number to something coming from a mutual fund, you're probably looking at needing more like $60,000 to be withdrawn from that mutual fund that same year to be a proper comparison. And of course, this is after you're 59 and a half because you're not paying penalty on it, I hope. But you got to be able to pay the taxes on it. So you need to have at least $60,000 in your mutual fund to be compared to the approximate $43,000 here, depending on your tax bracket, in order to say that's apples to apples comparison. Okay. One more item here. Sally has now paid at age 80 a cumulative premium of $330,000. And she has accumulated $955,000 of cash value available to her. She has basically tripled her dollars safely, and she still has a death benefit should something happen to her of $1.2 million now, all from a relatively modest policy. And if she has any outstanding loans in the policy when she passes, those are simply subtracted from the death benefit, and the remainder goes to her heirs. Again, tax-free with no probate. And if she lives beyond 80, it only gets better and better and better. Now, I also haven't mentioned something else that comes with these policies that a lot of people don't realize. In fact, many of my clients don't know until I'm going over it with them at the end of our process. And that is called an additional death benefit rider. It comes on the policies automatically, but no extra cost, which means should you end up with a chronic illness or a terminal illness, you can actually access the death benefit early while you're still living so that you can use a generous portion of those dollars for anything you need, whether that's long-term care, in-home nursing care. Heck, you can use it to pay your adult son or daughter a wage to care for you. Whatever you need or whatever you even want. Let's just say, you've got a few months to live. You want to take a fantastic trip around the world, complete your bucket list before you pass. You can even do that with it. The flexibility is endless. This is the difference with a privately held, contractually guaranteed policy than from a government program. Not bad, if you ask me, for basically what I prefer to look at as a savings account. A savings account on steroids, maybe. Not an investment account, but it has guaranteed growth. No risk. It can never go backward. And from there, this is just a warehouse for your wealth. You can go ahead and borrow against it to conduct your investments. And yes, if you just love to invest in the stock market, it's your jam. Go ahead, collateralize, borrow against your policy to invest in your beloved stock market. Because at least then, if you do have losses in the market, your dollars are still safely growing inside the policy. And it will actually mitigate any losses you have, and your family will still be protected from loss whenever you pass, no matter how old when you pass. And if you're still not convinced these numbers are enough for you, go ahead, buy term and invest the difference. Put your family and your life savings at risk because you don't think the numbers jive. That is entirely your choice. But as for me, I'm going to stick with guarantees and good old-fashioned capitalization. And if I want to go invest, I can do that. Here's the beautiful thing. You can borrow against that policy, use the life insurance company's money, put an investment in place over here. My investor DNA is real estate. Maybe I buy another rental property and it grows and it appreciates and it creates cash flow. And my policy money is still sitting in there. It hasn't gone anywhere. I use the life insurance company's money. Now it's growing on both sides. You simply cannot do that with buy term and invest the difference. All right. I hope you found this eye-opening and at least worthy of your investigation. And if you really want to see the numbers as they might look like for you, because you might be younger or older than this 40-year-old, you might not be a woman. I get it. Do me a favor. Read Nelson Nash's book, Becoming Your Own Banker, and become a client. And then I will be more than happy to help you know what these numbers could actually look like for you. All right. You can find me at banklessbydesign.com or email me at tricia@banklessbydesign.com. Thank you so much for listening. Until next time, keep exercising your imagination, logic, reasoning, and prophecy. And you have a great week.
Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at banklessbydesign.com to learn how you can start living bankless by design.